Hey there and welcome to this explainer. Today, we are setting a very clear goal, mastering the structure of the Corporate Finance Department for your ACCA Business and Technology Knowledge Level exam. If you've ever felt a bit overwhelmed by the sheer number of roles in finance, don't worry at all. We're going to break it down logically so it's incredibly easy to remember when exam day rolls around.
To do that, we're going to look at four main pillars: financial accounting, management accounting, the Treasury Function, taxation, and then we'll wrap up with a quick recap. All right, let's jump right into Pillar 1, financial accounting.
So, overseen by the chief accountant, this first pillar is all about the past. It's the systematic process of recording, summarizing, and reporting your past financial transactions. Because these reports go out to external stakeholders, this whole area is heavily regulated by international standards. The absolute #1 priority here, providing a true and fair view of how the company actually performed. It's literally about documenting what has already happened, not guessing the future.
To pull this off, financial accountants create statutory reports. And for your exam, you absolutely have to know the big three financial statements, especially how they deal with time. Okay, so the statement of profit or loss and the statement of cash flows, both of these cover a period of time, say January through December. They show accumulative activities. But the statement of financial position, which used to be called the balance sheet, is a totally different beast. It's a snapshot, just a single point in time, usually right at year end. Exam questions absolutely love to test if you know the difference between a period of time report and a snapshot. Now, why go through all this heavily regulated effort anyway? Well, it's to satisfy external users. Think about it. Shareholders want to know how profitable the business is to ensure they get their dividends, right? Lenders and banks, they need to check your solvency before they even think about advancing a loan. Government authorities are checking up on legal compliance and tax reporting, and suppliers want to know your financial stability before selling to you on credit. None of these groups actually work inside the company, so they rely entirely on the accuracy of these financial accounts.
Moving right along, let's hit Pillar 2, management accounting.
Okay, let's dive into this, because we're talking about a massive shift in focus here. We are leaving external reporting completely in the rearview mirror and looking at internal strategy. Examiners frequently try to trick students by swapping these definitions, so keep this in mind. Financial accounting is for external users, historic data, and highly regulated. Management accounting is the exact opposite. It's for internal management, it's forward-looking, and the format is completely flexible. It's whatever helps the leaders make the best decisions. Because they're talking to internal managers, management accountants are focused on day-to-day operations and the future. They build budgets and forecasts, they analyze costs and revenues to figure out pricing. They do a lot of variance analysis, which is basically comparing what actually happened to what was budgeted and then figuring out why there's a difference. Oh, and they help with investment appraisals too, looking at long-term decisions, like whether to buy a new factory or an expensive machine. They serve up the customized data that managers literally need to steer the ship.
Next up is Pillar 3, the Treasury Function.
If accounting is the brain of the business, you can think of the Treasury as the heart, pumping the actual lifeblood, cash and funding. The treasurer has a very distinct set of responsibilities. They handle cash and currency management, protecting against foreign exchange losses, for example, and they raise finance. When a shiny new investment gets the green light, the treasurer has to figure out how to actually pay for it. Do we issue new equity shares, or do we take on debt, like a bank loan? They also manage the company's financial risks and keep a close eye on working capital. And speaking of working capital, which is essentially your short-term net assets, notice the constant balancing act a treasurer faces here. Look at inventory. Holding a huge amount means you can supply customers immediately, which is great, but holding just a little saves you a ton on storage costs and the risk of goods becoming obsolete. Or take cash. Having a massive balance means you can pay your bills promptly, but a small balance? That might mean you've cleverly invested that cash to actually earn profit somewhere else. The treasurer is strategically balancing these trade-offs every single day. It's like a giant puzzle.
And finally, Pillar 4, taxation.
Headed up by the tax manager, this function is basically a tightrope walk between strict compliance and strategic business planning. You really need to nail the terminology here for the exam. The primary goal is tax mitigation. That means legally reducing tax liabilities without frustrating the intentions of Parliament. Contrast this carefully with tax evasion, which is a straight-up illegal criminal offense. And then there's tax avoidance, which uses loopholes to defeat the spirit of the law. For the finance department, the goal is always ethical, legal mitigation.
At the end of the day, the directors of a company have a duty to their shareholders. So the tax manager's job is this really delicate balance.
they have to arrange the company's affairs to maximize the post-tax profits available for dividends, making sure shareholders get the best possible return, but they have to do it while strictly obeying the law and paying all amounts due to the tax authorities on time.
Okay, let's bring it all together for a quick recap.
Let's lock these distinct categories into your memory for exam day. Financial accounting, reporting past data to external users. Management accounting, planning for the future for internal users. The Treasury, funding the business and managing cash. And taxation, complying with the law while legally mitigating tax liabilities. 4 pillars, 4 very distinct roles.
I'm going to leave you with a quick scenario to test your dynamic thinking. If your business rapidly expands its product line tomorrow, which of these 4 functions do you think needs to react first? Is it management accounting, trying to forecast the new budgets? Or maybe the Treasury, scrambling to find the cash to actually fund the expansion? Think about how these interconnected departments rely on each other to support business growth. It's all connected. Thanks so much for joining me in this explainer, and best of luck with your ACCA preparation.